Yesterday, global oil markets experienced a massive contraction. The price per barrel plummeted 16% in a single trading session. We haven't seen a drop this severe since the height of the pandemic in April 2020. The reaction on Wall Street was explosive. The Dow Jones shot up over 1,300 points, while U.S. Treasury yields immediately retreated. The catalyst for this market euphoria was a 10-point ceasefire. Brokered at the last minute, President Trump signed off on the temporary truce with Iran just 90 minutes before a deadline threatening full-scale escalation. But looking past the green arrows on the trading floor, energy analysts are issuing stark warnings. The financial relief on paper does not solve the physical bottlenecks on the ground, and the core crisis is far from resolved. Wall Street is celebrating, but this sudden financial fix masks a deep, ongoing vulnerability that will continue to directly hit everyday consumers. To understand why the relief is temporary, we have to look at the 40 days leading up to it. On February 28th, military strikes were launched against Iran by the United States and Israel. This map details the geography of the Strait of Hormuz. In direct retaliation, Iran effectively blocked this crucial 33-kilometer stretch. That narrow passage normally handles 15 million barrels daily. When the strait closed, 187 oil tankers were physically trapped. The result was immediate. Crude prices spiked to $117 a barrel. Gasoline at U.S. pumps hit $4.14 a gallon, pushing global inflation forecasts into dangerous territory. Control over this narrow 33-kilometer passage gave Iran the leverage to spike global oil prices by 65% and trigger immediate inflation warnings in every major economy. Now, under the new 10-point truce, Iran agreed to allow safe passage through the strait. But there is a massive catch. Operations are strictly under the coordination of Iran's armed forces, meaning they retain total physical control over the waterway. This split-screen model highlights a harsh reality of economics. Digital markets can reprice oil in a fraction of a second, but physical supply chains require months to untangle. Because of that lag, the cost to fill your tank isn't going to crash overnight. Consumers might see prices tick down by just a few cents a day over the next several weeks. And even after absorbing the massive 16% drop, global crude prices remain about 40% higher than they were before the conflict began in February. A stock market rally does not rewrite physical reality. Elevated transport costs will continue to exert pressure on grocery and gas bills for the foreseeable future. Then there is the logistical friction. Commercial transport ships cannot move without massive maritime insurance policies, heavily anchored by institutions like Lloyd's of London. Despite the political agreement, Lloyd's issued a statement maintaining that the region remains at heightened risk. Without active coverage, most corporate shipping fleets will simply refuse to enter the Gulf. Beyond the ships, the infrastructure is compromised. During the conflict, extraction sites and refineries sustained direct hits, leaving damaged networks requiring highly specialized repair. At Qatar's Ras Laffan complex alone, the damage unilaterally knocked out 17% of the world's liquid natural gas export capacity. Rebuilding that output could take years. Political signatures in Washington cannot instantly rebuild shattered pipelines, nor can they compel global insurers to underwrite the massive risk of sending vessels into a volatile zone. We are already seeing the cracks. Within hours of the global ceasefire announcement, the agreement began fracturing on the water. Iran's Islamic Revolutionary Guard Corps quickly halted commercial tanker traffic moving through the Strait of Hormuz, asserting absolute authority over the passage. Their justification was immediate, citing ongoing Israeli military operations targeting Lebanon. This reveals a glaring loophole. The White House maintains that Lebanon falls outside the specific parameters of this deal. Because Israel can continue operations there, Iran maintains a perpetual built-in excuse to throttle the strait whenever it chooses. The 2-week window serves as a temporary suspension of hostilities, leaving the underlying economic conflict active and unresolved. If we zoom out, the last 40 days served as a highly successful proof of concept for Iranian leverage. By turning off the tap at a critical choke point, Iran demonstrated that it can influence the global economy without deploying a single nuclear weapon. Going forward, markets will have to price in a permanent geopolitical risk premium. This is essentially a hidden tax applied to global energy prices to account for this newly proven vulnerability. Whether this current truce holds for 2 weeks or collapses tomorrow, the balance of power over global energy transit has firmly shifted. The successful blockade demonstrated a repeatable strategy for holding energy markets hostage. Future energy security now depends on whether global powers can secure these narrow choke points against a proven method of economic disruption.